Welcome to TradeTheMBI.com. This is John. This report is for the 30th of August. And as we're about to close out the month, well, after the decline, we had a little bit of basing just above the ES or the S&P. I'll go full retrace. NASDAQ had already completed it. We're pushing back up against the 61% here in the pre-market. And we have the magenta just crossing above somewhat of a declining MBI readings. Likewise, we have tick up of midterm buyers as well as short-term buyers on the DOC, and still very negative from a shakeout standpoint, but we're in the green from a extreme histogram standpoint, coming off the deep red. That's a decent improvement. Doesn't mean it's going to be sustainable. White still leads, but is declining. So if white were to make a little bit of turnaround, obviously we're going to see that intraday action. But this would be expected within bear drop declines where you get significant down, return pop up as shorts cover, and buyers think that they found a discount and they jump back into that. Whether it's sustainable, no, that isn't something that we're seeing at this particular stage given what these readings are. You'd have to see a turnaround of DOC red and the green crossing above and that orange continuing its ride down. Now it started that way, so if it continues, that would be how it focuses. Pretty straightforward. So you can see from an NQ standpoint, we did hit that full fill of the positive extreme, and slight bounce, still below the 61% Morganacci lines here, but it's a little bit weaker, as you would say, comparative to the S&P, but that means we also had a deeper move lower. So clearly a tech movement, whether you want to call it over exaggerated or not, I wouldn't say that. I think that we're probably still elevated relative to what's happening. There's still pretty strong debate as to whether or not recessionary pressures are building or easing, and we're not going to know more about that until we start seeing some of the data. And like I said way back at the beginning of it, that it would be a sporadic type situation depending on your region. Would have a greater impact, particularly as it related to housing and desirability of location. And I think that's exactly how it's played out. It was pretty evident when it began that it was going to be a regional kind of, and more even than regional, just almost smaller area within certain cities would be exacerbated. We talked about California would probably suffer a little bit more. Than say some of your more popular East Coast places that had still higher demand, and residual wealth is really kind of where that goes, because some people aren't impacted as much by this inflation, whereas in certain areas you have a much stronger effect of draining that capital from working class environments. Euro moved back above parity at this particular stage. Still strong with that MBI readings, though. White still leads, so any pivot lower, and that's going to bring it back down to a new wave. There's still nothing. Yes, the EU is jawboning about being more proactive on tightening, but they really can't, given what their situation is. It's if they tighten further, they're really going to drive things into a depressive mode, and it just would not be helpful at all. Gold not making any move at this particular stage. Nothing exciting about the prospects. Yes, inflation's still going to continue to run at accelerated rates, which should drive it up, but there's a significant pressure to want to keep it under wraps, and that's been the case since the Fed's activity for almost a decade. They've been manipulating things to the point where it's been hard to really gauge a accurate price model other than you don't fight the Fed. That's the easiest price modeling right there, and which is why you can see accelerated prices. Plus, the market's discounting of what the Fed can do under these conditions, because they really are hamstrung given the situation. They really can't drive rates to what they would need to curb inflation, because that would just decimate the government budgets as well as drive the economy to a halt if it hasn't already begun to do that. And in which case, maybe they're going to get another, 3/4 points at best. I think that's even pushing it. And there's no reason to at this particular stage. Really, right here is where you're looking at the main impetus. If they were to drive oil prices down with change in policy, there'd be no issues at all. Everything would revert back, and you'd see significant deflationary pressures, in which case things would come along. It's really that simple. And the fact that they don't do it is interesting. Treasuries obviously have to see a decline in TLT here to drive rates up because they are going to continue to go higher. There's no question about that. And Bitcoin relatively trading to what the S&P on the recovery hasn't made an attempt back at its 50% off of the declining 50% off of the original move, but still holding above that 20. And so every time we get between that 22, 23 range and that 19, it finds plenty of support. So that's a strong aspect from there. And from an ES 50K, you can see that relative weakness. We've held below the 23%, but now we get declining 20%. 23% Morganacci with the falling 100. And when we get that falling 100, price tends to want to pull. First, it's going to try and get towards that 50. And as long as you don't see a pivot of this Magenta MBI below that 25, that would be the first sign that things are going to go soft on the turnaround. And from an intraday, it was pretty huge. We started off here with the decline from later than last week, and then moving into the beginning of the week. It was pretty soft there, and then we had some nice little buys, and everything was pretty clean. There was a lot of MBI white leads above that plus 40 range, which typically results in moves back to the 0%. They just took some time to develop, and then when they activated, they were pretty strong going through there. And that was because all of these little rallies, as you can see, popped up with positive extremes that once they started getting filled, they just found plenty of additional sellers who, once things based, started back with the next series of rallies. So there was plenty of buy support after that significant decline. If I make it all the way to the end of the day right here, you can see how this is much more normal to an S&P action with the wave up and down. Gave plenty of opportunities, both short, little longs, when we had a lot of these reds leading the magenta. When, like I've said, when the red leads the magenta, yes, it's still positive from a buy standpoint, particularly if you get the orange dips didn't quite go below red, so you knew it was going to be short-lived. And as soon as the white popped over and magenta faded, even if you wanted to wait another bar till it dipped below the upper line here and the 33 range, still produced a nice little dip down, but was unable to stay below the white. And then once it pivoted, that was the return rally. And then you did the exact same thing. So it was just for fluid action, you just had to be willing to make the moves. Now, of course, here we are starting positive extremes, coming all the way back just above where that previous one is, right around the 33 level. And then a second string started up a little bit higher at the 40-50. And that would be where I would think that we'll get the first fill. It may happen before market open, but if not, that's what I would be looking for intraday to fill at least that one back. And then any broader selling was going to take us all the way back down towards that 40-31. So that's what to look for as we get close to the end of the month here and finalize an interesting August. As always, though, trade well. You can look for indicator renewals in your email, and we will continue to plug away at it. See you on the Skype chat.